Today, let's talk about a foundational stock in the industrial sector to add to your diversified and long-term stock portfolio. Adding an industrial stock to your portfolio provides great diversification benefit. Although industrials might not be the sexiest sector, it's the bedrock of our economy. It's not going to go anywhere in the long term. Secondly, adding a best-in-breed industrial stock in your portfolio provides peace of mind. You can be assured that the stock will grow with the economy and deliver for you in the long term. Industrial stocks typically pay an attractive dividend to complement share price appreciation as well. Now, today we are going to talk about Eaton Corporation, ticker ETN, which fits the description of the best-in-breed industrial stock. We like Eaton for many reasons. First and foremost, Eaton is a transformation story. Although it's a century-old company, it has successfully pivoted into a higher growth, higher margin, and more consistent earnings play. To break it down into a couple of reasons. One, we think Eaton is the best play within the industrial sector. Industrial sector could mean a lot of things. It could mean defense, transportation, infrastructure, machinery, etc., etc. But one mega trend has transcended and revolutionized and will revolutionize the industrial industry, which is electrification, which is where Eaton is best at. Secondly, Eaton's growth will be turbocharged by several secular tailwinds, being sustainability and energy transition related to climate change and renewable energy, as well as digitalization, which is related to the explosive amount of data generated and the ability to harness them. And these trends are catalyzed by regulatory and policy incentives. Thirdly, Eaton has made a string of strategic and accretive M&As to position them in these attractive end markets and higher growth, higher margin end markets. In addition, Eaton has consistently improved their operating margin. As a matter of fact, in the past decade, they improved their operating margin by 50%. Last but not least, Eaton has reduced the cyclicality in the business, and now it's able to deliver a smoother growth profile. Welcome to Safety, Stocks and Investments for Serious Investors. At Safety, our mission is simple. Discover, analyze, and monitor solid companies for serious and long-term stock investors. We are not investment advisors. We are simply sharing our own research as individual investors, leveraging our experience in investment banking, strategy consulting, CFA background, and MBAs from top and Ivy League business schools. If you like what we do, follow us and subscribe to our channel. Today, we'll discuss 3 things about the company. Number 1, what they do. We'll look at the company's business model and strategy, its competitors, and its historical performance. Number 2, what we like about the company, including industry trends that benefit the company, its competitive advantages, and peer analysis. Number 3, when to buy the stock. We'll look at the company's share price trajectory and historical valuation. We'll look at analyst ratings and target price, and given all these analyses, our point of view on when to buy the stock.
Hi, I'm your other co-host for this presentation. Basically, as serious long-term investors, we believe having a strong foundational understanding of the company is essential in making these investment decisions. We are here to help you with that and also share our point of view on what we believe is a right entry point for the stock.
Awesome, let's get started.
Okay, so let's dive into what this company does. At its core, Eaton is a power management company. So let me talk a bit about what power management means. Nowadays, we take electricity for granted. It's a given. How intrinsic electricity is to our day-to-day lives, whether you live in an apartment, single-family home, or you work in an office location, doesn't matter. It's ubiquitous. So power is typically generated, electricity is typically generated in some sort of power plants that are located all across the US. And then the transmission lines that you see when you drive on highways, they are the transmission lines. But before that electricity comes into our homes or offices, there is an entire set of infrastructure that is required, which is where Eaton comes into play. For example, Eaton manufactures components such as transformers that basically a transformer is a device, a huge device that you see on the roadblocks that will reduce the voltage that is coming from these power plants and transmission lines. Before it enters your household, these transformers bring that voltage down from like 48,000 or 100,000 volts voltage to like 120 or 240 voltage that we see for our devices. So transformer, basically think about it as it transforms the power in the electricity lines is like 300, 400 times higher than what we consume at our homes. So transformer transforms that voltage down. Similarly, power distribution units, they bring it down a bit lower and then transforms accordingly and distributes accordingly to how much is needed in your parking garage versus to a factory versus a household. Switchboards and circuit breakers, they're nothing but, let's say when you use a hairdryer at home or you use a microwave or a toaster and something happens and that gets short circuited, the rest of your electricity in your other rooms and in your other electricity lines still stay intact. That is where the switchboard and circuit breaker comes in. And nowadays, over the last 20 years or so, you would have heard about alternative or renewable sources of energy, such as the solar power or the EV charger or like electric power, either to power your homes or to power your vehicles. So that Eaton also manufactures them. And there is an interesting concept called uninterrupted power supply. So nowadays, there are some mission critical systems. Say there is some hospital equipment when a doctor is performing a surgery or data centers. The power has to be uninterrupted. That's where Eaton's UPS, uninterruptible power supply, comes into play. Similarly, the energy storage systems, they are able to, electricity, as you may know, it has to be consumed instantly in real time. But the energy storage systems do provide that backup power during like hurricanes or storms. Eaton interestingly started when it started in the 1911, in the early 1900s. It started as a component manufacturer for trucks and automobiles. So it started producing gears, clutches, transmission, powertrains, etc. that are like the beating engine of your car and automobiles. So those are some of the other products that Eaton plays in.
Yeah, so basically these are mission critical equipment and components that you may not see, but they work very hard behind the scene to make sure electricity usage is safe and reliable.
Let's take a look at some of practical examples of where Eaton's products are used. If you're a homeowner, for example, most likely you would be using Eaton's devices such as a smart load center, meaning once the electricity comes into your house, how do you allocate and load balance the electricity across all your devices like washer, dishwasher, washer, dryer, or your EV charging station for your cars? So that's what that does. In addition to that, there is a EV charging panel for your automobile, and there is a energy storage center. They also provide some home energy management software where you can see insights. So all of that is being powered by Eaton's products. Another practical example of Eaton's customer base or where Eaton's products are used include factories, warehouses, offices, commercial buildings like your malls, shopping malls. So the complexity of the type of products here is much higher compared to the residential buildings, just given the type of energy usage and the type of use cases that would require Eaton's equipment.
Another one of Eaton's end markets is utilities, or power plants and power grid. This is not a new industry. This picture actually shows a group of horses helping to install high voltage power lines near the Canadian-US border in Niagara Falls. Now, some of this is still in commission today. The US power grid is not as old, but many of them were installed 50, 60 years ago during the Eisenhower presidency. What's new today about the grid and power generation is they need to accommodate new sources of energy generation, which is renewable energies, and they need to accommodate new electronic applications like EVs and data centers, and this requires the grid to be modernized.
So these utility companies, the one that I use is like Con Ed, and in the past I used Dominion Energy. So these companies are Eaton's customers. Another important customer segment or type of customer of Eaton is all these data centers. So imagine the tons of data that we produce and consume on a day-to-day basis, whether it is social media like TikTok, Instagram, or all the pictures we take, or all the data that companies store about their customers. Everything is being stored in these data centers, which is a very important and growing customer segment.
Correct. In the past 10 years, data center actually drove majority of the growth in the electrical equipment segment.
So far, we looked at Eaton's customers such as residential buildings, office buildings, factories, warehouses, data centers. Now let's also take a look at the other type of customer segment that Eaton serves. Interestingly, Eaton started as a company that supplies components for automobiles and trucks back when they were invented in 1900s. They used to manufacture components such as brakes, like transmission gears, clutches, powertrains, and recently they pivoted into battery storage within your cars. So for example, they have a product called Breakter, which tells the car when to use the gas power and when to use the electric power. They do the same thing for trucks as well. And nowadays, in the last 10 years, they pivoted towards the electric vehicles, providing charging terminals and the panels underlying and all the technology underneath that. So the car manufacturers, original equipment manufacturers, OEMs, they are the customer. They are customers of Eaton.
Another type of Eaton's customers is the manufacturer of aircrafts. And think about fighter jets, passenger planes, helicopters. These are highly engineered components that go into an airplane and regulates the airflow, electricity flow, and fuel flow within the plane. Now, many of you guys might have watched the famous Top Gun or Top Gun Maverick movie where Tom Cruise refuel his fighter jet in mid-air while in the flight. So Eaton recently bought a company that manufactured components that enable this mid-air or air-to-air refueling action. In addition to manufacturing components and equipment, Eaton also provides value-add services, and especially in the past year or two, they developed a software suite called BrightLayer. The idea is Eaton's equipment and components already generate and capture a ton of data, and through BrightLayer, Eaton is able to turn this data into useful insights for a host of end segments, such as utilities plants and factories and commercial buildings, and help the management of these business or the management of their customers to achieve operational excellency, save costs, manage electricity more efficient. To summarize, Eaton is an intelligent power management company serving across multiple end markets. Today, it's a 21 billion revenue company, and its end markets can be roughly divided into two main groups. The first group is the electrical segment, which means the electrical equipment Eaton makes will go into stationary structures such as commercial buildings, data center, factories, power plants, homes, as well as big machinery. And Eaton is pretty balanced across these electrical end markets. The second group of end markets would be the industrial end market, which includes the aerospace, vehicle, and e-mobility subsectors. Think about it as electrical components that would go into vehicles that move, such as cars, trucks, as well as airplanes. All in, the electrical segment, again structures that don't move, stationary, accounted for around 70% of Eaton's revenue. And the industrial segment, those are things that moves, account for 30% of its revenue.
Eaton has an interesting history. It started in 1911 as a mobilization company, meaning the cars were just invented back then in the 1900s. So it started as a component supplier, such as clutches, brakes for automobiles and trucks. And then 40 years later, in the 1970s, they expanded the same technology, such as valves and brakes and hydraulics for the industrial segment. So that's the diversification. In the 2000s, they pivoted towards energy efficiency. There are a lot of power sources in the 2000s. In addition to the coal and oil and the gases, there is the renewable energy. So they transformed themselves as a power management company in the 2000s. However, within the last 20 years, as of 2020, 2022, they pivoted themselves as a intelligent power management company, given all the sustainability, electrification, digitalization, tailwinds that we talked about. They pivoted themselves to how you can effectively act as an intelligent power management company for your end customers. They do have manufacturing facilities across 36 countries. And then their customer base extends across 170 plus countries. Overall, by revenue, they generate like 55% of their revenue in US and 45% internationally.
Now let's take a look at Eaton's historical financial performance. In terms of top line, it's a little bit choppy over the past 5 years. One of the reasons is this top line growth here incorporates the M&A effect. To put it in perspective, for example, in 2019, Eaton divested their lighting business, which generated 1.6 billion of revenue. And so because of this divestiture, in 2020, this divested business generated zero revenue. As a result, the 2020 revenue growth was minus 17%. So the divestiture actually contributed to the volatility of their top line. A better way to look at underlying growth, top line growth, would be organic revenue growth, which we'll expand in the next section. Even though the top line growth is a little volatile, Eaton managed to expand their operating margin from 2016 to 2021, actually a 4 percentage point expansion from 11% to 15%, and their operating margin is pretty consistent in the past 3 years, despite choppy top-line growth. Now, Eaton is also a strong cash flow generator. In 2021, cash flow margin is at 19%, and because of this strong cash flow generation, Eaton is able to support its acquisitions, its growing dividend, as well as the leveraging after M&A.
Now that we talked about what the company does, the products it offers, its history, who it competes with, its customer profile, and its financials, why don't we now take a look at what we like about this company? We believe Eaton is perfectly suited and being benefited from three long-term mega trends that are not just shaping Eaton's business model, but several different industries across several different geographies. The first one is sustainability. Virtually like 194 countries in the entire world agreed for Paris Climate Accord or Paris Climate Agreement, where they pledged towards some sort of climate change and sustainability goals as a country. Also, every corporation nowadays started reporting on ESG reporting, which is environmental sustainability goal reporting, where they pledge themselves as a corporation to reduce their net carbon emissions. So this trend across governments and across corporations and virtually almost all S&P 500 companies is being driven by some of the underlying factors such as the climate change or renewed focus towards more energy efficiency, and of course like the increasing regulations as well by the government bodies. For example, California aims to for every new home construction in California, they have to have a solar roof. And starting from 2035, California requires no more new cars using the internal combustion engine, which is like powered by gas or oil, but it has to be electric. The second trend is digitalization. We talked about data centers extensively. Once again, Eaton's big customer base is the data centers. So think about all the new business models that are emerging from things like Internet of the Things, where different devices talk to each other. Think about your fridge being connected to your phone, where you can control your fridge temperature or your when to turn on and turn off your watering in your garden via your smartphone. So that's all digitalization, where Eaton's devices power that trend as well. The third one is energy transition. So this is basically electrification that is happening over the last several decades, but more importantly, accelerated in the last few years. So this is about leveraging new sources of power, such as renewables like solar, wind, uh, to power your machines, factories, homes, and automobiles. So this is all the electric energy renewable transformation that is happening, where once again Eaton is perfectly suited via their product portfolio. End of the day, all of Eaton's customer segments or end markets are being benefited by these three long-term mega trends.
Talking about government support for the first megatrend, sustainability, the world's largest economies are throwing their weight behind this megatrend. US is pledging $440 billion to tackle climate change and energy transition and grid modernization, based on the two landmark legislations passed in the last 12 months. Europe is pledging a trillion of euros spent to achieve climate neutral in 30 years. China and India, both the world's biggest population centers, are pledging to achieve carbon neutral or to reduce emission intensity of their respective economy.
As the entire world, like corporations and governments, pivot towards this global goal of achieving net zero carbon energy system, electrical industry is a key driver that is helping enable that. So net zero carbon or net zero emissions basically means you as a apartment building, office building, or a factory cannot or wouldn't emit more carbons into the atmosphere than you consume. In 2017, if you look at the traditional electricity mix, how do you produce electricity? You could see that coal and oil are the major forms of energy generators. Renewables is very small in 2017. But shifting forward to 2050, you could see that the expectation is that the coal and oil would become very less in terms of producing this electricity, but you can see the clear spike in the renewables. So renewables is going to be the major electricity generation power form by 2050. To expand on the electrification trend and how Eaton is taking advantage of that, one of the recent monetization concepts or themes that is evolving is everything as a grid. So if you think about the end customers, whether you are a commercial building, residential building, or a data center or a factory, you are consuming electricity from whoever is providing that electricity power. So it gets generated, it gets transmitted and distributed, and you are consuming. So it's a one directional data flow. But in the last 10 years, one of the recent trends that is happening is these end customers are able to not only consume in a one-way fashion, but they're able to generate electricity by installing solar roofs or EV equipment and storage devices. So the concept is that whenever you have additional electric capacity, you can sell it back to the grid. Meaning, for example, you have a lot of electricity being generated via your solar or EV infrastructure. You can not only consume it, but you can sell it and monetize those infrastructure investments that you made in these renewable energies. So Eaton is very well positioned as an intelligent power management company to enable these end consumers not only consume, but also generate, store, and sell that and monetize those electric investments.
As an example, we already talked about modern residential homes that are equipped with solar panel and EV chargers on site. As your solar panel generate excess electricity that you don't use, you can sell it back to the grid and offset your utility bill. And this is all enabled by Eaton's products.
And not only that, by equipping your modern homes with this type of renewable energy infrastructure, you're able to increase the value of your home resale price. Another key segment, customer segment of Eaton is the commercial buildings like shopping malls, offices, or warehouses. There are actually thousands of them in the US and across the world where Eaton operates. Nowadays, we see increasing acceleration of electrification across these commercial buildings for ESG and sustainability purposes, where they're installing additional solar roof, additional EV charging infrastructure. End of the day, they are not only acting as a net consumer, but also a generator of power. So all of this electrification trend that is happening in the commercial buildings is being powered by Eaton.
With the support of these industry megatrends, the market for electrical equipment is expected to grow at 4.8% CAGR in the next 5 years. Eaton is expecting to or target to deliver almost double the market's growth by outgrowing the market across its end markets. In particular, data center would be the main growth driver here through both organic growth and M&A. In addition to above industry growth, we also like Eaton's competitive moat in the electrical segment. The key to be an effective competitor in this segment is the ability to deliver turnkey solutions using a full suite of products, which Eaton does. At a global scale, there are only a few companies that can compete with Eaton, such as Amazon Electric and Bell in the US, and ABB and Schneider Electric in Europe. Because of this consolidated industry setup, they have very high barrier to enter for potential competitors, and the industry players have very strong pricing power. Now we covered what we like about Eaton's electrical segment, which accounts for 70% of the company's revenue. The remaining 30% is the industrial segment. As a reminder, this segment produces components that go into airplanes, electric vehicles, and trucks. The market for industrial segment is expected to grow at 5% CAGR in the next 5 years, and Eaton is targeting 3% outgrowth compared to the market, with a total of 8% organic growth to 2025. And this is mainly driven by its e-mobility segment, which is expected to grow at 27% CAGR through 2025. A key part of Eaton's story is its strategic M&A. In the past few years, 3 years, Eaton makes some bold move in M&A to transform itself into a higher growth, higher margin company with more consistent earnings. To put in perspective, in the past 3 years, Eaton acquired $7 billion worth of business across 10 acquisitions, while divesting or selling $5 billion of businesses. And these acquisitions are focusing on high growth, high margin, high quality companies, while they sold lower margin, lower growth, low lower quality companies. Put it in perspective, the acquisition they made will generate 7% revenue CAGR versus 2.5% CAGR of the business that is sold. And the acquisition will have 27% operating margin versus 12% margin of the business that they sold. And more significantly, these acquisitions will generate $2 billion of revenue, while the divestitures will sacrifice $4 billion of revenue. Now think about when we talked about Eaton's choppy top-line growth in previous section. As a matter of fact, Eaton is so confident of the higher quality business that they acquire, they are willing to sacrifice 20% of their revenue to transform itself. Now, within the acquisitions that they made, the focus is on higher growth segments. For example, 2 deals in data center, 2 deals in electric vehicle. Remember, we talked about these are all high growth segments going forward. In addition to that, in the aerospace segment, they also acquired 2 highly engineered high margin business, including the mid-air or air-to-air refueling business we talked about.
In addition to this strategic M&A driving higher growth and higher margin, Eaton is also increasing its international diversification across emerging markets. For example, its Turkish acquisition in the electric component space, serving all of Europe, Middle East, and Africa, and the 2 emerging market joint ventures that it did in China, in addition to the aerospace investment that it did in a French company serving across all of Europe.
To complement the impressive M&A, Eaton also invests in internal R&D to develop breakthrough solutions across the electrical and industrial businesses. In addition to that, they also deploy venture capital to invest in software business. We also like the fact that Eaton has become a less cyclical business with a more stable growth profile. Now, industry typically is cyclical, meaning it goes through boom-bust cycle along with the up and down of the economy. Eaton was one of those typical industrial companies 10 years ago. In the 2009 financial crisis, at the depth of the recession, Eaton's top line declined 23% and recovered to 17% in 2 years. That's 40 percentage points swing. Now fast forward to 2020. During the COVID-induced recession, Eaton's top line only declined by 5% and then recovered to 12% 2 years later. That's only 17 percentage point swing, and that's half of the swing it experienced during the financial crisis in 2009.
So Eaton has been investing in less cyclical, recession-proof type of businesses.
That's right.
Complementing this very thoughtful top-line revenue growth, both via inorganic expansion via M&As and organic new product development and R&D, Eaton overall has been becoming a more profitable business. If you look at the last 20 years and looking at its operating margin for each of its segments on an average, it's been growing from a low teens to higher teens, a significant percentage improvement, becoming more profitable. In addition to that, Eaton also has been generating a more cash flow, free cash flow as a percentage of its top line revenue. If you remember, we talked about the significance of free cash flow in our other video, salesforce.com CRM. Essentially, the free cash flow is important because you are able to deploy this additional free cash into R&D and new product development. For Eaton, it's been pretty impressive growth over the last 20 years.
Cash flow also benefits Eaton because it's able to pay a decent dividend, and it has been growing dividend in the past decade. And so when we look at total shareholder return, or TSR, which incorporates both share price appreciation and dividend, Eaton has outperformed S&P 500, its peer group, over different time periods across 1 year, 3-year, and 20-year periods. We also compare Eaton's performance and valuation versus its peers. Here we divided the peers into two groups, Eaton's closest competitors as well as other industrials. Let's focus on Eaton's competitors for a little bit. Now, we already talked about Eaton's choppy top-line growth because of its active M&A activities. The 5-year CAGR for Eaton is 0% or flat, which put it at the bottom of its competitors' peers. However, if you believe in Eaton's management target organic growth of 5 to 8%, you will see that would put Eaton's growth in line with its peers' top-line growth. Now, moving on to operating margin, we already talked about how Eaton is a margin expansion story. Its operating margin expanded from 12% to 15% from 2017 to 2021, with a 5-year average at 14%. That puts Eaton in the middle of the pack versus its competitors. However, if we believe in Eaton after the transformational M&A Eaton did in other organic innovation activities, Eaton would be able to further expand its margin. It would put Eaton in line with best-in-class competitors such as Amazon and Schneider. Now, because of looking at the valuation, because of Amazon's balanced growth profile and higher operating margin, the market has given it a higher valuation at 23 times PE, compared to Eaton at 20 times. But again, if we believe Eaton's going to be moving closer to the best-in-class peer, which is Amazon, in terms of revenue growth and operating margin, Eaton has some potential to expand its valuation multiple in the future. In summary, Eaton's top-line growth is below peers, but if you believe in its target growth of 5 to 8%, it would be closer to the peer median. Operating margin is in line with peers, and PE multiple is above peers. So I think that points to the fact that the market has already priced in Eaton's potential at the current valuation. In terms of Eaton's share price in the past 5 years versus its peers, Eaton has returned 116% in the past 5 years, only second to John Deere, which doubled the return at 207%. Now, John Deere, we all know it operates in the agriculture sector, and its performance is tied to agriculture commodity, which is highly cyclical, and it's impacted by uncontrollable external factors like weather around the world. And so although John Deere's share price gained a lot since COVID, which coincided with a commodity super cycle tied to supply chain and other weather issue, there's no guarantee that John Deere's performance would not deteriorate when it goes to the other side of the cycle. To recap, Eaton is a solid number 2 compared to its peers when it comes to 5-year share price return. Now, Eaton is also a solid number 2 when it comes to total shareholder return. As a reminder, total shareholder return also incorporates dividend reinvestment, and Eaton has been paying a good dividend. We also compare Eaton's share price performance versus indices. When it comes to Eaton versus SP 500, Eaton's annual share price performance has consistently outperformed S&P in the past few years. As a matter of fact, on an average basis, Eaton outperformed S&P by 9 percentage points. When looking at Eaton versus the broader industrial index by looking at XLI, which is a mutual fund comprised of a lot of industrial companies such as Honeywell, John Deere, Lockheed, Boeing, etc., Eaton outperformed industry sector consistently in the past few years as well, and on an average basis, Eaton outperformed the broader sector by 9 percentage points as well.
Now that we talked about what the company does and what we like about it, let's talk about the million-dollar question: when to buy this stock?
Let's take a look at Eaton's share price performance in the past 5 years versus major indices. Before COVID hit in March 2020, Eaton's share price performance more or less tracked SP 500 and Nasdaq. Now, since COVID hit in March 2020, Eaton has seen its share price increase a lot between March 2020 and November 2021, which was the last peak of the market. And this was driven by multiple reasons. First, during COVID, Eaton actually delivered quite solid quarters, including very solid order book build-up, exceeding analysts' expectations. Secondly, Eaton has done, we already talked about Eaton doing a lot of M&As between 2019 and 2021, and the results start to show during this period. And number three, since COVID, everything's moving online, and so the mega trend of digitalization accelerated during this period, which benefit Eaton as well. Last but not least, there's this legislation component that serves as an incentive. In November 2021, U.S. actually passed the landmark infrastructure legislation that included a lot of incentive for energy transition and renewable energy, which Eaton also benefits. Now, we all know the market entered into bear market since late 2021, and Eaton's share price bottomed actually in July 2022. But since then, Eaton's share price has bounced back strongly and even outperforming Nasdaq since around, call it September 2022. And that was driven by one, solid quarter again, and two, another landmark legislation passed in the US, which was the Inflation Reduction Act. On top of that, around November 2020, inflation started to show sign of easing, and market was betting on the Fed would start moderated interest rate hike, and that drove Eaton's share price and the broader market even higher. Given Eaton's share price resilience during the COVID era and its recent share price run, it's now trading at 20.4 times on a PE basis. That is higher than its 10-year average PE, which supports our view that Eaton is fair valued, if not slightly overvalued in the current market. As usual, we took a look at how Wall Street analysts look at Eaton. In terms of analyst ratings, majority of the analysts still rate Eaton as a buy. However, when we look at the target share price, the median target is at $171, which is only slightly higher than $165, which means the analysts see a limited upside for Eaton at its current share price. So, what is the right entry point? Eaton's share price is around $165 level now. It's pretty close to its all-time high and analyst share price midpoint at around $170. And we talked about how Eaton share price could be fairly valued or slightly overvalued now. And so we think there's room for us to wait for a better entry point. Then how low can it go? Looking at recent floors or resistance level, it's at around 125 to 134 level. And given the economy, the uncertainties within the economy, we think the market definitely has room to go lower and hence a better entry point for us. Given all this information, we think an entry point at around or below $140 could be achievable and reasonable. All in, we believe Eaton is a foundational stock to add to your long-term and diversified stock portfolio. However, taking a conservative view given the looming recession in 2023, right now we will recommend you to add Eaton to your watch list and continue to monitor for a better entry point, which we believe is around $140. We will continue to update you on the latest about Eaton through our YouTube channel, Thesis. Please subscribe and follow us at Thesis on YouTube and visit our blog at www.thesis.com.